Good afternoon, everybody, depending on where you are tuning in from. My name is Jason DeBono. I'm the president here at Newview Trust Company, and I am going to be leading us through some really fun, exciting topics, all centered around tax advantage strategies. It is somewhat boring, but I'll try to make it as lively as possible, and certainly hope that everybody gets an opportunity to really understand not just how to win the investment game, but how to win the tax game. And we'll talk a little bit about that over the time we've got together. Forgive the background here. I'm actually out in San Diego today. I'm not presenting from our office in Florida. And so I'm here in sunny California. So it is morning time for me. But I am here at a conference called EDISA. It's a financial services conference. And I'll be delivering a panel tomorrow on some of the technology initiatives out in the advisor community. So, getting some both to impart some wisdom and then also getting to sit in on a lot of great sessions and continue to learn and understand how the investment market is navigating through, kind of the headwinds that are ahead of the investment opportunities that sit out there today. And we're going to talk a lot about tax strategies at this conference, and I'll be excited to kind of share some of those with you guys today. So without further ado, we'll go ahead and hop into it. I've got Maggie in our office helping out with the slides today just to make sure that technology doesn't fail me here remotely. So as always, if you do have questions during the live stream, you can type those in on whatever live platform you're watching us on. Those questions do come. I can see them, and I'm happy to pause and get those read aloud. So as we go forward today, please get those chat questions hopped in. I know tax strategies will try to simplify things, but certainly can create a lot of questions as we go. So we'll go ahead and get to the first slide here. And, the first thing I want to make sure you guys kind of see, if you'll click us forward, Maggie, is we are not accountants. We're not attorneys. We're not CPAs. We're not here to tell you what to do with your money or how to invest it. We're going to talk about tax strategies today, but please understand that we're going to use generalized terms. We are not going to go through and try to calculate any sort of tax opportunities at your individual level. So taxes are personal. Make sure you've got good qualified tax professionals in your corner, and they can help you kind of take this discussion and actually make it real as it applies to your own tax situation. Next slide, please. So we're going to talk about taxes, and I want to just illustrate why taxes is so important. So many people kind of focus on investments, and being an alternative asset custodian and a custodian of self-directed retirement accounts, people always talk investments, right? I want to buy real estate, and we talk a lot, and you probably heard me if you've been on any of our previous educational bits, is there's really two separate discussions and decisions when it comes to investing. And one is both the investment and the second is the tax opportunity. And so I just want to highlight the way that taxes impact the way that we invest. So we're going to take $1 and we're going to double it 20 times. Now that seems like a very simple calculation, right? $1, then $2 and $4, $8. Sorry about that, guys. I think my internet cut out for a minute there. Hopefully, you can hear me okay, Maggie. Let me know if there's any sort of technical issues. All right. So if we take this dollar and we carry this through and double it over 20 times, there's really two ways to look at it, right? So the same dollar being doubled for the same period of time. So we'll consider that the same investment over the same time horizon. Maggie, if you click through, if I make the first doubling, if I double this account $1 at a time, but I pay 25% tax every year. So year one, I take $1 and turn it into $2, but I owe tax at 25% on $1. Therefore, I've got $1.75. I do the same thing, $1.75 and double it, pay 25% tax, and whatever's left, I double again. If you look at this all the way down, we take $1 and over the course of 20 doubling periods, we'll call those years, I've turned that into $72,570. Now, certainly if we started with a double, we'd all be elated to end up with $72,000. Now, what I want to illustrate here is that that's the tax liability associated with the investment. And to underscore how much the tax actually is, I'm going to kind of walk you through this exact scenario, assuming that we do this in an IRA and we don't pay tax annually. So that means that when I do double a dollar, it turns into two, and then I have two to reinvest to four. And as you can see, the amount of difference is staggering. So you go from making $72,000 at the end of 20 years after a tax rate of 25% annually to $1,048,000 simply by doing this in a retirement account and not paying tax each year. Now, I can't illustrate enough how much of a difference there is between $1,048,000 and 72,000. We're talking about nearly $1 million. So when you think about taxes, we don't tend to actually understand the cost of tax. But the cost of tax in this scenario is nearly $1 million when it's all said and done. Now, you can crunch the numbers yourself. I'm sure you're probably a bit speculative saying, well, that seems like too much. These numbers are, in fact, accurate, and these numbers do tell the story of how much taxes take out of your investment. So, when we talk about investing, it's why we talk about great investments are great investments, but great investments coupled with good tax strategy is actually how you win this game. And so, the wealthy don't get wealthier by making great investments; they get wealthier by making great investments coupled with great tax strategy. So when we take a look here and we kind of carry this through today, we're going to talk about taxes as really the primary source of opportunity. Now, if you'll click through to the next slide, there's really two ways that you can win the tax game, and there's multiple ways. But one of the ways I want to talk about is a Roth conversion. Now, if you take that $1,048,000 that you have by using an IRA, you have a secondary decision to make, which is inside of that IRA, do you want to pay tax up front, which is a Roth, or do you want to pay tax at the end, which is every other type of account? Now, the benefit of paying up front is that you pay on the seed, not the crop. And so if you took that example of $1, you pay tax on a dollar and you have $1 million tax free. The alternative is that you get a deduction on that dollar, yet when you withdraw the 1,048,000 little by little, you pay tax little by little. Now you can kind of crunch the numbers at whatever tax rate you think you'll be in at retirement. And in any scenario, paying tax on a dollar is certainly going to benefit you, a lot more than paying tax on 1,048,000 or 1,050,000. So ultimately, let's talk about why people consider Roth conversions and the four factors that I want everyone to be really taking into consideration. And what we're doing here is we're taking money that we've already saved for retirement, traditional SEP, simple 401k money, and we're saying, hey, is there an opportunity today for me to convert that money into a Roth? Now, the drawback of the conversion, if you will, is you got to pay tax. The benefit of the conversion is you pay tax today and you make that money tax free forever. So, a couple things. Number one, we want to look at our current tax rate. Well, why current tax rate? Well, that's because the tax rate that we're currently in is what we'll pay tax on during the conversion. The second thing we want to look at is what's the future tax rate? Well, future tax rate means that if you're, say, 40 years old and you believe that you're going to retire and start withdrawing at 60, you have 20 compounding periods to obtain tax free growth. So that's 20 years of tax free growth that would factor into your decision. If you only have 10 years, right, of growth, then the decision would be different. Or maybe you had only 5 years till you plan to withdraw, which is the third category. And then the fourth is asset market value. Now, the reason that I bring this up is because a lot of people don't realize that you can convert both cash or assets. Now, cash conversions are easy, right? You have 50 grand in cash, it's a $50,000 conversion. But the reason that I really like to highlight this asset conversion is there's a lot of opportunity, especially if asset prices drop, to do a Roth conversion. So I'll illustrate this in a stock for simplicity. So if you were to look at March of 2020, which is the official announcement of COVID, the market bottomed out, right? Everything sold off. So if you had $100,000 worth of Apple stock, it may have dropped down to 60,000 bucks overnight. And what ended up transpiring over the next 2 years is that Apple stock had doubled, right? Not just doubled from where it was, but it actually, or doubled from where it dropped to, but it doubled from where it was originally. So that $100,000 investment became 60, right? You could have converted that to a Roth IRA at the $60,000 valuation. And as that stock grew, and maybe it's worth 150,000 today, you would have had all of that income tax free. So what we're doing is we're looking for opportunities to convert. And that opportunity may not be based on an asset, but it may be based on a drop in income tax rate. It may be based on losses that you have in other areas of your life that allow you to convert. So if you go to the next slide, one of the things that we really like to take a look at is, from a Roth conversion standpoint, it's not a matter of if you should convert. It's a matter of when you should convert. And with good tax strategy, excuse me, with good tax strategy, planning is essential. And it's all about timing. So, a couple things to really consider for those that are on the call. One is you may be in a lower tax bracket than usual. So, if you see your tax bracket dip for any reason, that certainly creates an opportunity. If you think future tax rates are going to be higher, and we see this for a variety of reasons, right? It's hard to believe that we'll see lower tax rates 20 years from now than we're seeing today. Market value may be lower today on an asset that you believe still has better value. So if you own a piece of property and the market has compressed, and maybe that valuation is 20% lower than what you bought it for, right? Maybe the market doesn't allow you to sell it for what you bought it for a year ago. Well, that may give you an opportunity, if the value of that asset has dropped, to do a Roth conversion, because the Roth conversion doesn't take future value into consideration. It takes current snapshot in time value into consideration. So if you think there's an opportunity, that can certainly be a good one. When you think you're going to earn above average returns, so if you're going to turn a dollar right into $1 million, which we certainly hope everybody that has an account with us does, well, certainly the higher the return you expect, the more favorable the Roth IRA becomes. The last thing is, income restrictions likely will prevent at some point Roth conversions. Now, I can't say that with certainty. I only say that because it's been put into the ether in Congress multiple times. Now, it hasn't made it through into law, but it's been brought up, and our belief and the belief of a lot of people in the industry is that at some point they may start looking at Roth IRAs and making them restrictive again. Now, we're hopeful that never happens, and it may never happen. But for those of you that are high income earners, you may want to look and see what's going on in Congress to determine if and when there may be some restriction that would prevent you from converting. And if you believe that to be the case, then certainly the when becomes a little bit sooner for you. Next slide, please. So there are three asset classes that our clients primarily invest into. Now, you may be in any one of these or all three of these, and there's many beyond the list that I'm going to share, but I just want to highlight these, and we'll talk about it from a Roth conversion standpoint and the why. Now, I mentioned real estate earlier, and real estate creates opportunity, and real estate certainly can go up and go down in value. But even when real estate drops in value, income may not drop. So a rental property that you paid $300,000 for may only be worth $200,000, but the rental income likely will be the same. So converting that to a Roth basically makes your dividend tax-free, but it allows you to convert at a lower value. And so there's a lot of real estate opportunities out there that may have that available. Distressed real estate, right? Real estate that may not have a significant value today, but may have a higher value tomorrow, is also opportunistic for Roth conversions. So when we talk about real estate, it is an asset class that runs the gamut. We see development real estate create great Roth conversion opportunities as well. You buy a property, whether you're part of a fund or syndication, or whether you buy it directly, but through the development phase, the value of that asset is actually going down. And the reason for that is it's not been built out. You really can't sell a property that's only 25% completed without selling it at a severe discount. And so we see the market value on paper annually drop. In some cases, we've seen it drop 30, 40, 50%. Yet when that development is ultimately done, 6 months, 2 years, whatever the development timetable is, that value, as it leases up, starts to shoot back up. And so taking advantage of a Roth conversion during that time of development can also make real estate an opportunistic item for a Roth conversion. Next slide, please. Notes probably has the least amount of opportunity for Roth conversion from a valuation standpoint. However, private loans are coupon based, meaning there's typically payments. They're like dividends, whereas real estate doesn't always have a dividend. The reason a lot of people like to convert their private investments in notes is that they already know the return. If you have a note at 12%, you know that it's going to yield you 12%. And so it's a little easier to forecast the value and benefit of a Roth conversion. The other thing is that we see a lot of Roth conversions on distressed real estate. So, that's something that's been a lot of on in the media today is the distressed opportunity, especially in commercial real estate. And so we're seeing clients that are purchasing distressed real estate at a discount, and they're converting that into a Roth. And so they buy the distressed, let's say a $200,000 note for $100,000, and they're converting at the $100,000 valuation. And the goal is to obviously make that non-performing note perform and hopefully perform to its full potential. Therefore, the Roth conversion amount is significantly lower than the future value of that non-performing loan that becomes performing. Next slide, please. Private entities or private equity. This can be real estate based, but a lot of this may be private businesses. And so we talk a lot about the opportunity to convert. Businesses have different valuations, different years. Some businesses have great years, businesses have bad years, businesses have losses, businesses have a variety of things. And so when we say it's a matter of when you should do it, not if you should do it. If you're invested into any sort of private entity, you should be looking at the financials on an annual basis to determine, is there an opportunity for me to convert, either at a value that is maybe not a discounted value, but you may convert because the business has a huge potential. Maybe there's a big sale coming. Maybe there's a big contract they can sign, or maybe there's some venture groups that are looking at an acquisition. All of these things that may make the investment worth significantly more money. As a result, right, we may want to convert before that activity so that we get the bump in valuation inside the Roth tax-free. The second would be at a decreased valuation, right? A business is only as valuable as its income. And so if the income, for whatever reason, has dropped in any given year and it lowers the overall value of that company, it may just be temporary, right? The value is lower today because sales are down, but sales may be up tomorrow, or expenses may be up, given inflationary challenges. And as a result, you get a lower valuation. And when that happens, that too presents opportunities for Roth conversions. So regardless of the asset class that you're in, Roth conversions can be a great opportunity. Now, you'll notice the bottom bullet there says UBIT or UDFI may apply. Now, we're going to talk about tax and opportunity inside an IRA. Now, we've talked about Roth conversions. We've talked about paying Uncle Sam income tax on our IRA accounts and getting that out of the way. We talked about making Roth conversions strategically, whether that be a cash conversion or whether that be an asset conversion. Either way, you have the ability to be deliberate. You have the ability to select the right time to convert, and you have the opportunity to decide when you pay tax on your IRA. And what we're trying to accomplish is getting that tax bill paid at the lowest amount as soon as possible so that the growth from that point forward is 100% tax-free. There's a lot of opportunities there. I know we kind of covered a lot in pretty short order on that piece of it, but certainly if you have questions on Roth conversions, certainly we encourage you to talk to your accountant. Understand your tax rate, understand the tax bracket that you're in, and understand Roth conversion opportunities as it relates to your personal taxes. If you want to talk with one of our specialists about how Roth conversions work, how does it work to convert an asset, and maybe opportunistic times as it relates to your investment strategy, we can certainly do that. Lastly, I'd encourage you to take a look at the value of your IRA-owned assets on a regular basis. And anytime you see a decrease in value or diminished value or a potential jump in value, those are the times when you should be most strongly considering Roth conversions and taking advantage of getting that tax bill paid at the lowest amount. So one of the things we're going to shift gears to and talk a little bit about is unrelated business income tax or unrelated debt financed income. Now, these are scenarios where people pay tax inside an IRA. Now, you may be saying, Jason, you're here to tell me how to not pay tax, right? Why are you telling me about investments that trigger a new tax? Well, the reason for that is because the power of these investments can be really big. And I want you to understand the tax liability so you don't run away from it. I want you to understand the tax liability so you run directly into it. Now, there's two taxes. They're like cousins. They both work under the same tax code, which is Publication 598. One is called unrelated business income tax. Now, unrelated business income tax is a tax that an IRA pays when it invests into a operational business that doesn't pay tax. So I'll give you an example. If I invest into Microsoft, right, I'm investing into a business with my retirement account. UBIT does not apply. And the reason UBIT doesn't apply is because Microsoft is a tax-paying entity. Therefore, Microsoft pays the business tax and only gives me money after business tax has been paid. Yet, if I were to invest into a startup software company that was set up as a LLC that didn't pay tax at the corporate level, then the IRS says, Jason, your IRA is going to pay UBIT tax because the business didn't pay the corporate tax for you. Now, this isn't a bad thing. In fact, this may be incredibly opportunistic because it allows me to invest into businesses that may be small, they may be startups, and they may have huge upside, right? You may have heard the term unicorn, right? These are businesses that go from, having very low valuations to being billion-dollar companies overnight. Now, we're not suggesting that every investment you make will be a unicorn, nor should you set that as your investment strategy. But UBIT may actually be the best tax you could pay if you invest into a company that is a pass-through that may be small in nature that has huge potential upside. We're not going to spend much time on UBIT today, but just understand that if you invest into an operational business, you will potentially have UBIT if the business is not paying tax at a corporate level. Now, that's, again, not a scary thing, and there's some exclusions to that. If you invest into an entity that is tax paying, or you invest into into a syndication or a fund that is not an operational business, or is in the real estate business, which is considered excluded from UBIT, then typically you have no tax to worry about. But we want you to be aware that that tax may be triggered. On the contrary, where UDFI is, I believe UDFI is a major opportunistic tax. What I mean by that is it's a tax that in most cases could and should be worth paying. Now, again, we want to avoid tax, but we also don't want to lean away from tax if that tax gives us benefits. And so UDFI is around debt financed income tax on debt financed real estate. And I'm going to walk us through some examples of how it's calculated. And then I'm going to walk us through some examples of the why behind it, as well as illustrate how it actually is more opportunistic to buy real estate with leverage if you underwrite it correctly than it is to buy it cash on cash. So if you go to the next slide, and you guys can kind of take a look, there's a lot going on here. But UBIT is business income tax. So if you just think of UBIT as the business tax, it only applies when you invest into a business that doesn't pay tax on your behalf. And then if you go into the next slide for me, please, Maggie, you'll see some exclusions here. So from a UBIT standpoint, royalties, rents, real property are excluded, which is nice. So if you invest into a business that's real estate related, typically you won't pay UBIT on your income. But if you do invest into an operational business, you will likely have a UBIT implication if that business does not pay tax. Next slide, please. So what is UDFI? So this is a tax that I want everyone to kind of lean into. UDFI is unrelated debt financed income. It typically applies when you have debt leverage on real estate. Now, we tend to think of a lot of investments, or real estate purchases tend to have debt. Yet in an IRA, it's more common actually for them to be cash on cash purchases. So that means that if it's a $300,000 house, someone's paying cash for it. Now, there's benefits to being a cash buyer, certainly, but I'm going to illustrate why the leverage can actually expand your purchasing power and generate you much higher yields as a percentage and in terms of dollars when it's all said and done. So when we talk about UDFI, what we're really saying is you have the ability and opportunity to actually go out and buy real estate with leverage inside an IRA. And as a result, you've got to pay Uncle Sam unrelated debt financed income tax. Now, if you think about this and compare and contrast this to the stock market, you cannot buy stocks in an IRA with margin. Now you can do it with your personal money, but you cannot buy real estate or sorry, stocks in an IRA on margin because in order to obtain financing in an IRA, it must be non-recourse. Non-recourse means the asset is the sole guarantee that the lender gets. And the irony in all of this is that there's a laundry list of people that will line up to loan you money for real estate secured by real estate alone. Yet nobody will line up to write you a loan secured by stocks and stocks alone, which is kind of an interesting irony in the grand scheme of an investment philosophy that nobody wants to actually own the stocks or will take that risk. Yet they'll take that risk because it's easier for them to calculate and they believe it's a lot lower in real estate than in stocks. Next slide for me. So the way that UDFI works, and don't mind the years on here, this is an IRS document, but yes, this dates back to 1971 in their illustration. And the way that it works is very simple. UDFI is a tax that is owed on the leveraged portion of your investment profits. So if you take the average indebtedness, so let's call that $50,000 of debt, and a property that's worth $100,000, you're going to get a calculation of 50%. So if you take 50%, right, which is the amount that we leveraged, times the income, let's call it 10 grand for the year, then 50% of the $10,000 or $5,000 is subject to UDFI. Now, I know I'm running through a lot of numbers and I'm doing it without a whiteboard, but if you just pause for a minute and think, if you earn $10,000 of income into the IRA off the property and you had 50% leverage, 50% of your 10 grand or 5 grand is subject to UDFI. So that means 50% of your profits are 100% tax-free back to your IRA because they originated from money that the IRA brought to the table. But the 50% that the bank loaned or that was loaned to the IRA is not IRA money in the eyes of the IRS. And so their view is that 50% of your profits, in this case 5 grand, will be subject to that tax. So there's some strategies that we're going to talk about here as it relates to going out and making an investment in real estate using leverage. But if I do the basic level calculation here, all right, in very simplistic terms, the percentage of debt against the value of the basis of the property is how you're going to determine how much debt you actually, or how much UDFI you actually owe. Right. So again, using round numbers, if you borrow 50% of the purchase, chances are your UDFI calculation will be right around 50%. So when you look at that on a go forward basis, that means 50% of your profits, including income and sale, will be subject to this tax. Now you may be saying, well, why wouldn't I just buy it cash and then I don't have to pay the tax? And the drawback to buying it cash is you can only expand your purchasing power by one, meaning if you have $1, you can buy something $1. Yet if I look at using leverage, I may be able to turn my dollar into $2 or $2.50. Because the power of leverage allows me to buy more. Therefore, the return on that bigger asset or more assets is going to be higher, even though there's a tax liability to be paid. So if you go to the next slide, please, we'll just walk through a very simple calculation and what the actual cost is. So if I take a $50,000 loan on a $100,000 property, with $10,000 of income, I'm going to have $5,000 of UDFI. I'm carrying the same exact example from the last slide. That means that I've got $5,000 that I have to run through the table that's listed here. It's the same table that is used for trusts as well. So if you notice, right, we're going to take the $5,000 and we're going to go down to the second tier. And it says it's because our $5,000 is between $2,651 and $9,550. You take $265 plus 24% of the amount over $2,650. So the amount over $2,650 is $2,350, right? That's $5,000 minus $2,650. I take the $2,350 times the 24%, which is $564. I add it to the $265, and the tax liability for my IRA on the $5,000 of earnings is $829. Now, let's run this through in a total scenario against if you bought this cash. So if you bought a property cash, you would have invested $100,000 and it would have yielded you $10,000 and you would have taken that tax-free to the IRA. In this scenario, you invested $50,000. You brought in $10,000, but you had to pay $829 in tax. So your total return in this case is $9,081 or $71. as opposed to 10,000. But if you take the $10,000 and compare it to your investment, which is 100 grand, you made 10%. If I take the 9,000 81 $71, sorry, $9,071, which is the amount after I pay my UBIT tax, and I compare that to the 50% that I put, or the 50 grand that I put into the deal, my return is closer to, in this case, closer to 20%. So you're almost doubling your return, right? Just under doubling it by virtue of using leverage. That is when things are very powerful from an investment standpoint. So if I take this scenario and carry it out as an investor, I could buy two properties with leverage, 50,000 down on both properties, and invest the same 100 grand. But instead of returning 10 grand, I have two properties, which means I'll yield 20 grand. And if I pay, just round up to $900 of tax on each one, I'm making $9,000 of return twice. I've got $18,000 of income on the same $100,000 that a cash purchase only yields me 10,000 bucks. Well, if I look at this, would I rather control two properties? Of course, because I've got the appreciation opportunity on two properties. Would I rather collect the $10,000? Of course. Now I've got debt service that I've got to calculate into that as well. But as a result, I'm going to yield a much greater return as a percentage and over time in dollars, because I control two properties with double the income, even though I add a new expense line in the form of debt service. It's a powerful way to invest and a powerful way to earn money inside a retirement account. You'll click to the next slide. So a couple of things that I want to point out. Number one, if you are going to be buying real estate with leverage, meaning you're going to go out, and obtain a non-recourse loan, then you're going to want to take a really hard look at a solo 401k account if you qualify. And the reason for that is solo 401ks are exempt from UBIT tax and from UDFI tax. So if you're going to look and take an opportunity to buy real estate with your retirement account and use the power of leverage, take a strong look at the 401k account, and any one of our sales specialists can walk you through, what that account looks like. In today's day and age, with opportunities to make self-employed income, it's very easy to qualify for many people. So if you're going to buy real estate with debt, certainly start with a 401k. The second is that UDFI is only taxed on debt that has been encumbered on the property in the last 12 months. So I'll give you a real world example of my dad's IRA and something that we did years ago when he set up his accounts. He used leverage and he bought two properties instead of one, almost the exact same scenario that I've given you guys. And he used the income from those properties to pay off the debt. And he paid the debt off both properties a year and a day before he sold either of them. And the power of that is that now his properties don't have any UBIT calculations or UDFI calculations because he's actually paid off the debt. So if he were to sell either of the properties that he bought, he would not have to pay UDFI on the disposition. So that means that where the biggest gain is, which also triggers the highest tax rate, he's going to be tax exempt. So he's had to pay UDFI tax annually in very small amounts, few $100 a year, because he had income and he had debt. But as he brought in the income, he paid off the loan and then used the proceeds from other IRAs to pay off the debt. And now he owns two properties free and clear, completely debt free, and no longer subject to UDFI. So as he liquidates those properties and makes very handsome returns, he will not have to pay any level of tax on those returns. So that's a real strategy. I see a lot of clients that they'll use the model of I think it's referred to as BRRRR, right? Buy, rehab, rent, refinance. And so they'll go through and use leverage, and they'll use the value of property A, and they'll take on debt to buy property B, and then they use the value of property B to buy property C, and they'll continue that process so they can acquire as many properties. And as they liquidate those properties, right, they can use the income off of selling property one to pay the debt off on property two, so that when they liquidate property two, they don't have UDFI implications. Again, A lot of strategy here, and we're not trying to make you experts, certainly not in a 30 or 40-minute presentation, but we want to give you the information so that you can continue to do research. We have additional videos on our YouTube channel, and we'll continue to do more live streaming classes on these tax considerations. If you do have questions, please get those typed in, and I'll get those read aloud as we kind of wrap things up. We got a couple more slides to walk through. Another opportunity, and this is again probably an advanced strategy, is actually to set up a C corporation and pay tax at a corporate level instead of a trust level. We've seen this as well. This would require some pretty good strategy, and it would also require you to do it, typically on larger deals. But in the event that you're invested into a business that has significant income opportunity, or you're investing into a lot of real estate or large scale real estate development that may have many investors, a blocker corporation allows you to make the investment through the C Corp and let the C Corp pay tax as a C Corp. And in a lot of cases, the tax rate is a lot lower. The highest tax rate in the trust table can get up to 37%. So it can get expensive. So the C corporation or blocker corporation is a strategy we've seen deployed to reduce the tax liability. It will not eliminate it, but it will reduce it. The other thing to just be aware of, UDFI and UBIT are paid by the IRA. That is a tax to the IRA, so you do not pay the tax personally. It's paid via 990T, which is the tax form that's created, and those tax forms can be created by any tax professional. We do not create those on your behalf, but we do file them with the IRS and make the payment on your behalf. So if you do have UBIT or UDFI considerations and your accountant has produced the appropriate 990T, you can submit that to our firm and we will get that paid out of your account and reported to the IRS accordingly. Next slide, please. So I'll kind of walk you through an example here once this opens up, and kind of give you some insight into the difference between leverage versus cash. Now, I walked you through the example on the rental side, but I'm going to walk you through where UBIT really may cost you the most, and that is on disposition, because the amount of earnings are typically going to be higher than you're making from a rent standpoint. So if the purchase price is 100,000 and we sell it for 200, it really doesn't matter how long we hold it in this scenario. But we use 50% leverage. That means we put $50,000 down and we borrow $50,000 via non-recourse loan. The way that the calculation would work upon sale is that you take your profit, in this case, $100,000. You multiply it by the leveraged amount. In this case, we're just going to use 50% as a round number. Now, this number may reduce over time as you pay that mortgage off, right? Your average indebtedness over the last 12 months may only be 48% or 42%. So the longer that you hold it and the more debt you pay off, the lower percentage of UDFI, which is great, because the lower the amount of UDFI is, the lower the dollar amount of taxable income. So using just very round numbers here, we take the $100,000 of property, we take the 50% or profit, we take the 50% of leveraged amount, and our total UDFI calculation is 50 grand. Now, I don't have the table on this slide, but I had it in the previous slides. If we take the 50 grand and put it into the trust table, it says that we owe $3,146 in tax plus 37% of the next $36,949. That equates to $13,600. You add those two together, the tax liability for this is $16,807 or $17. Now, that is the highest amount of tax because we haven't factored in any sort of expenses, depreciation, writes off, steps up in basis. None of that was considered here. And that's because that's the most integrate calculation. We're doing this at the highest level. But I want to illustrate, even at the highest level, why this makes sense. So if you take the $100,000 return or profit and you take the $16,817 of tax, you have a net gain after taxes of $83,182. If you take that $83,000 and compare it to the $50,000 invested, your return is 166%. Now, while you returned less in real dollars than if you did a cash on cash return, which is took 100 grand and wrote a check and made the same $100,000, you would only have 100% return. So you have 16,000 more dollars technically, right? In the than the deal originated, but as a percentage, you've made 166% return instead of 100. And if you would have done two of these exact same deals, right, instead of the 100, you put 50 and 50 and leveraged both properties, you would have ended up with $166,000 of money as opposed to only $100,000. So you're making 60% more return just by using the power of leverage, even though you're paying tax for that power of leverage. So again, I share this because I want you to lean into UDFI. I don't want you to lean away from it, but you need to understand how it looks, what it looks like, and what opportunity it presents. But I'm a big fan and a big believer that leveraged real estate is how you build true wealth. It may not be for everybody, so it's up to you to underwrite your own deal and determine whether or not leverage is something you consider opportunistic, or if you want to be a cash buyer. Either way, you can do either in a self-directed IRA. You're not under pressure to do either one, but it's where we want to highlight how, again, the wealthy get wealthy because not because they always avoid tax or minimize it, because they are willing to lean into tax via leverage, but they also want to lean out of tax by using 401ks to avoid the tax and using Roth conversions to get income tax paid on these accounts upfront and eliminating that from the future tax liabilities that they would incur if they kept it in a pre-tax or tax deferred arrangement. So we'll go to the next slide here, which I think is our question slide, and certainly open it up if we have any questions that have come in. And I've got a couple here that I can go ahead and get read aloud here. But we'll pause for just a second to see if any additional questions come in. Remember, whatever live streaming platform you're on, you can certainly type those in, and they'll find their way to my screen, and I'll happily get those read aloud. All right, first question that came in is, where can you obtain a non-recourse loan? Great question. Thank you, Dave, for asking that. So if you come back and kind of go to the beginning of our discussion about leaning into this tax, we talked about going out and taking on a non-recourse loan for buying real estate. And the reason that you need a non-recourse loan is because in an IRA, you cannot personally guarantee the loan for your IRA. Now, that's stuff we discuss in many of our other classes around disqualified parties and prohibited transactions. But for the sake of today, we're going to just leave it there simply. But this question around where can I obtain a non-recourse loan is one we get all the time. And they usually ask, well, if it's a non-recourse loan, is it a hard loan to get? Are there very few lenders that offer it? And believe it or not, it's actually not a very hard loan to get at all. In fact, in commercial real estate, non-recourse loans are the norm. So what a non-recourse loan is, very simply put, is it's a loan where the collateral is the only thing securing that loan. Now, how that differs from a normal real estate transaction in the residential world is that not only is the property collateral, my personal guarantee is the second level that I give the bank in terms of security. In a non-recourse loan, I actually only have the property as collateral, and I personally am not on the hook. And so typically the reason that non-recourse loans are a little harder to find is because they're not typically provided regularly to residential real estate. That said, where can you obtain one? Going back to Dave's question, we have a list of institutions. There are two banks, national banks that do it. First Western Federal Bank, as well as North American Savings Bank, will both write non-recourse loans throughout the entire U.S. Most regional banks will do non-recourse loans. So depending on the area that you live in, local regional community banks, we have plenty in Florida near our operational office, as well as we see clients obtain them throughout the entire United States from a variety of regional lenders. So what you're looking for in a non-recourse loan is simply a loan where the income produced off the real estate pays the mortgage. So a lender is not going to write you that loan unless they can validate that there is enough income, let's say $1,500 of rent, to cover a $1,200 mortgage payment. And that's ultimately what they're looking for. So if you do need a list of non-recourse lenders, you can send an email to IRA specialist at newviewtrust.com. And they'll get that. You can also email me directly if you'd like, and that's Jason, Jason, at newviewtrust.com, spelled with a U. And I can have our team get that non-recourse lender list out to you. All right, continuing down, we got a couple more questions as we wrap up here. Next question, and it looks like it's a follow-on question, which is, what is the standard interest rate that you're seeing on non-recourse loans? Great question, Janet. Thank you so much for asking. So interest rates on loans is a little hard for me to answer, and I say that because we're not the lender, right? And the lenders are all over the U.S. and they're all different types. Not only are they banks, but they can be individuals that write these loans as well. We also have seen hard money lenders write non-recourse loans at higher interest rates based on property that may need repairs. So whether it be private or public, there is no there is no universal way to really understand interest rates, but I'll just kind of share what I've seen. Typically, we see on the bank side more traditional rental properties. You're not buying it with the intent to repair it, right? These are typically bought solely for the purpose of renting out. We're seeing 1 to 1.5 or 2% higher than standard interest rates on a normal mortgage. So if you're seeing rates in real estate today at, let's say, 6, you can expect to pay in the 7s for a non-recourse loan. Now, you can certainly pay more than that if the property may not be as lendable, or it may be something that you're trying to get a loan against after repaired value, in which case you may be getting private or hard money. And rates there could be anywhere from 8, 10, 12%. Depending on the lender, the property, and the deal itself. So it's something that you want to be mindful of. You certainly want to understand what the interest rate looks like, but also understand, something that a lot of people don't take into consideration is interest arbitrage on real estate. And that is that if you buy property and the interest rates go up, it actually makes your loan better. Your loan is actually performing better because you have a lower interest rate. The beauty is if you buy when interest rates may be higher than you would like, you have the ability to refinance that down the road, right? So your real estate at 7.5% may be a good deal, and if rates go back down to say 4 or 5%, and you refinance, now that real estate becomes a great deal because the value of the interest arbitrage by going from 7.5 to say 4.5 or 5 is going to be money into your pocket, right? So that's quite a strategy as well. So a lot of people run away from rates as they go up, and most people will tell you if the deal underwrites at 7%, it's only going to get better because it's fixed rate, which means if rates go up, your property is going to be worth more typically as a result because you have a better loan on it. And then if rates go down, you have the ability to take advantage of that arbitrage by simply refinancing out and moving into a lower interest rate. So definitely something to take into consideration. Another question that came in, this is a question asked by Jay. Jay has asked, from a tax standpoint, will most accountants be familiar with UDFI or UBIT? So Jay, great question. The answer is, from my experience, I'd say 50-50. We find that many tax professionals may not understand the tax as it relates to IRAs, but they do understand it as it relates to nonprofits and other exempt organizations where the same tax does apply. So sometimes just asking for, do you know what a tax is in an IRA may not necessarily, give someone the actual or your accountant the right information. But if you ask your tax professional if they've ever filed a 990T on behalf of a tax exempt organization, chances are they have, and they can translate that code right over to the IRA side. So that's something, if you do find your tax professional that you're using doesn't understand it or doesn't know what the calculation is, you can also reach out to us and we can give you a list of some accounting professionals that we know and firms that will be able to do that UDFI and UBIT calculation for you. At this point, I don't see any additional questions that have come in. I'll pause for just 1 second here and see if we get any last minute questions, but thank you to those that did ask questions on our live stream. We appreciate it. For those of you that joined us today, thank you so much. We really appreciate you taking the time to continue to expand your knowledge and understanding of self-directed IRAs, as well as the opportunities that they present. And so our goal is to continue to educate the world on how self-directed IRAs work, how to truly build wealth by not just focusing on your investments, but focusing on your investments coupled with good tax strategy. And hopefully today, from an advanced standpoint, you got a little bit of food for thought on some strategies and considerations as it relates to the tax side of the equation to be coupled with the investment side that you guys are already so good at. So I don't see any more questions. So thank you all very much for joining us today. We'll wrap up. And you can watch this down the road at any point on our YouTube channel. We'd encourage you as well, while you're on our website, to take a look at our All About Alts podcast that we launched a few weeks ago. We have been having a lot of fun with that and talking a lot about a variety of investment and tax strategies, as well as bringing in some really good guest speakers to help us understand some of the areas that they're experts in as it relates to the investment world or the tax strategy world. So take a look there. Certainly would encourage you to like and share our podcast, as well as any of our other educational content. Continue to expand your knowledge and expand your opportunity. And as a result, good things will come from the investment standpoint, and wealth will be built. So thank you guys very much for joining us. We'll see you guys next